Well, hello everybody. Thank you for coming and listening to us today. My name is Dale Bethel, Bethel Law Corporation, and today we're going to talk about something that I'm asked a lot about when I sit down with various clients of ours with regards to charitable contributions. Surprisingly, I get a lot of calls, or I should say a lot of questions, about just how to do it, how to provide a charitable contribution to your favorite charity. So today we're going to go through the initial makeup of that, and I hope it helps. And with that, we'll get started. So really, when it comes down to charitable planning, there's two basic ways of doing it. We can do a traditional approach, which I'm sure everybody knows. This is where you simply give money to a charity for that particular year. But there's also the estate planning approach, which breaks down into using either your revocable living trust or getting a little more complicated and actually using charitable type trust. Now, the traditional approach is something that I'm sure everybody is aware of. This is where you just pick a charity that you'd like to help on a yearly basis. You provide them with a contribution of money, is usually the way of doing it. And with that, you want to get a gift receipt. I know the IRS has certain guidelines as to whether you have to prove that you gave the money to it as opposed to not, based on the amount that you give. But I would highly recommend that no matter what amount you give, you always get a gift receipt so that you can explain and show the IRS if there's ever any kind of audit that you may have to go through. Now, this is a one-time tax advantage that year that you contribute to that charity of your choice, and we've given some charities down here as an example of the ones that we do work with a lot. But with it, this is the traditional way of providing a charitable gift to the charity of your choice. You contribute the money, you get a gift receipt, and you get that one-time tax advantage on your tax return. Now, there's another avenue when it comes to charitable planning other than just the traditional approach. We're going to be talking a little bit now about estate planning and actually including charitable planning within your own family estate planning. Now, again, it boils down to two ways of doing it. You could use it through your normal revocable living trust, or we could get, again, more complicated and use charitable trust. But first, let's talk about the living trust approach, I should say. Bottom line is, I'm assuming just about everybody already has a living trust who's probably listening to this presentation. But for those of you who do not have a living trust, you may well know that there's really a two-step process. The first process is, of course, creating the trust itself. And this is where you sit down and basically talk to the family and figure out exactly, who your heirs are and how much you want to give them. And those heirs can also be a charity. So in your living trust, you can provide a specific gift of a certain amount or even a percentage as to the charity of your choice. Now, in setting up a living trust, it's not about just creation of the documents. You also have to fund the trust with the various assets and properties that you and I have determined should be titled under the name of the trust. So the creation process with a normal revocable living trust, for those who don't have one, is that you, as the maker of your estate, is also going to be the maker of your trust. So we call you a trustor. You are the manager of your estate, and you will continue to be so in using your revocable living trust. So you are the trustee of your own trust. And in addition, you are the first beneficiary of your own trust. So as you can see, when it comes down to a revocable living trust that's typically set up to avoid probate and keep your affairs private and make sure that you don't have to end up in court or your family does, you will set it up in such a way where you're the maker of the trust, you're the manager of the trust, and you're the first beneficiary. So as you can see, you're in total control of this trust from beginning to end. You can decide whatever you want to do with it. It is really up to you. You could put properties in, you could take properties out, you can change the beneficiaries. You always have the ability to amend and change it. So when we deal with charities with a normal revocable living trust, besides just people or your family that you're picking as beneficiaries, you will also pick that charity. Now, normally when we do this, we also not only want to know the name of the charity, but we'll want to know the address of the charity, and then maybe what you want that charitable money to be specifically used for. You can have it sent to a general fund, or you can actually lay out exactly what those funds should be used for. These are things that we would naturally go over with you when we set up the documents in the first place. So with that in mind, a trust is not done just by signing it. We do have to put the gas in the engine to make it go, which means that assets do have to be titled under the name of the trust. Specifically, your real estate is going to go under your revocable living trust to avoid the probates. Your large savings and or CDs should be under the name of the trust. And all your stocks, bonds, mutual funds that are basically in after-tax investment accounts should also be titled under the name of the trust. In addition, if you're a person that owns a business, we want the business interests to be under the name of the trust. Specifically, if we're dealing with S corporations, C corporations, limited liability companies, or even for that matter, family limited type partnerships. Now, what normally does not go under the name of your revocable living trust is your after-tax investments like IRAs, 401ks, 403bs, any other type of retirement plans that are out there. Life insurances, annuities also do not go under the name of the trust. Now, when I sit with you and go over this process, we'll discuss all that in detail, of course, and you'll see exactly how it is all laid out. When it comes to using charitable trusts rather than your revocable living trust to pass monies down to charity, a charitable trust is what we call a standalone trust. But you'll notice that it gets set up exactly the same way that your revocable living trust does. It is a two-step process. So the first process, of course, is to create the trust itself, and we'll go over the details with you on exactly how you would like that laid out, and we'll put that into the document exactly as you tell us to do so. Now, we also need to fund the trust, which means we have to decide what asset you're going to donate to charity and therefore title under the name of that charitable type trust. So the creation process for the charitable trust is very much the same as setting up your own revocable living trust. Yes, you as the donor of the property to the trust, you are the maker of that trust, so you will be in a sense called the trustor. You also can be the manager of the trust, so you'll be in control of managing the charitable trust, even though you are putting property into that charitable trust ultimately to benefit charity. So as you can see, you as trustor, you will remain the maker of the trust, and you can remain the trustee throughout your lifetime. And if you design the trust in such a way where it outlasts you for a term of years beyond your lifetime, you'll have, of course, a successor trustee who will step in at death or your incompetency, just like a revocable living trust. So with that in mind, what is the difference between a charitable trust and a revocable living trust? Well, just like the titles say, a revocable living trust means it's revocable. That means you, as the maker of that trust and the manager of that trust, have the power to amend and change it. With a charitable trust, this is an irrevocable type trust. Once it's set up, it's in stone. However, you will now have yearly management. You will have to acquire a federal tax ID number, which we of course do for you. And so you will have to file a separate tax return on the charitable trust every year under that federal tax ID number. With your revocable living trust, everything is reported to the IRS under your own Social Security number. So there is some yearly management when it comes to a charitable trust. What you're doing is, literally gifting the asset that you're going to put into that charitable trust away from you. And that's the reason for it being irrevocable with the federal tax ID number and having its own tax return. So the actual transfer process itself really boils down to what we want to put into the charitable trust. Now, typically speaking, it is highly appreciating assets and or real estate. Real estate, usually when it gets donated into the charitable trust, will get sold within that charitable trust. And then as a result of the sales proceeds stay in the charitable trust where you're the manager, the trustee, and then you invest it. And you invest it for ultimately what we get out of the charitable trust itself. Highly appreciating assets, stocks, bonds, mutual funds, those are typical that could be put into it. However, when we get, I should say, a little more complicated with my more sophisticated clients, typically what we can also put into a charitable trust is certain interest in either a family limited partnership or interest within a limited liability company. And that's when we get into having a lot of fun, in my opinion, on how to plan, how to set up these documents, and how to make it worth your while for a family and especially for the charity. Okay, so what types of charitable trust is best to be involved in? We're going to talk about two, which are the basics. You can get very complicated with the details in how to arrange the charitable trust. I'm not going to get too far into that today, into the weeds of it all, but we're going to talk about specifically the charitable lead trust and the charitable remainder trust. Now, the charitable lead trust is really underutilized. Most people usually hear about the charitable remainder trust, which we'll save till last, but I think the charitable lead trust is a very popular trust in the sense that it should be used a whole lot more than it actually is. But here's what I mean by it. When you get or set up a charitable lead trust, you as the donor are going to contribute the cash and or the assets like the real estate to the trust itself. Now you're also going to be the trustee. Now how it works in terms of a lead trust, you're providing now income that's earned off the charitable asset to the charity basically on a fixed schedule for a term of years or for your lifetime. You get to pick either one, you know. So if you're very elderly, then it would be normal to pick a 20-year type term that would outlast you, the trust itself. Or if you're young, then the idea would be you would want to pick a lifetime term, you know, for the charitable lead trust. But the beauty of the charitable lead trust is that the corpus or the property that's actually put into the trust is returned to the family at the end of the term. So in this case, again, the charitable lead trust is about providing an income stream to the charity throughout the term or the lifetime. And then at the end, the trust corpus returns right back to the family itself. If you ever want to go in to see who's used trusts like this, look up Jackie Onassis. This was the family planning strategy for the Onassis family when Jackie actually passed away. Now, the other type of trust that's involved with, or we do get involved with, and most people usually pick, is a charitable remainder type trust. So again, how this is done is that the donor, you as the trustor of the trust, contributes the property to the charitable remainder trust. Now, instead of the income going to the charity, the income is actually goes to you, the family, throughout the term that you pick. Again, you know, 20 years or lifetime. Now, at the end of the term, though, the corpus of the trust, the asset, actually goes all out to the charity. Now, the beauty of both the charitable lead trust and the charitable remainder trust is you do get an upfront charitable deduction, you know, as a result of your donation of the property or the asset to the trust. And you'll notice that in the charitable remainder trust, even though you get the upfront charitable deduction, at this moment in time, you are not giving the property directly over to the charity until the end of the term. Now, common types of charitable remainder trusts. There's really two types that we work with a lot. One is a charitable remainder annuity trust, where this provides a fixed amount of income per year back to the family, even if the amount actually exceeds what has been earned by the charitable trust on the investment. So again, this will not hedge against inflation, you know, because you do have that fixed term, but it could chew up the principal somewhat as years go by if their earnings on the principal don't match the actual fixed amount of income that you want per year. So you'll notice the last bullet on the left side there basically states that at the end of the term, you must have at least 10% of the initial trust corpus remaining in order to close out the trust term and, of course, be legal. Now, a charitable remainder unitrust is a little bit of the opposite of the annuity trust in that it provides the family a fixed percentage of the assets as income per year. So therefore, the charitable remainder unitrust hedges against inflation. In the sense that every year you do have to recalculate or value the property to determine what your percentage is going to be. So valuation of property like real estate that's just sitting in the trust, producing maybe rental income, what have you, that could be a little cumbersome to do every single year, which is why we recommend that if you're going to put real estate into the trust, that we actually sell the real estate within the trust, and therefore you invest the sales proceeds, which gives you a nice brokerage account to work off of in terms of reevaluating the actual value of the trust itself every year. You'll have a nice statement that tells you, and it's very simple going forward in that regard. And one thing I haven't mentioned, I don't think, if you put real estate inside that charitable trust and then you sell it, guess what? You have no capital gains as a result of its sale. So for example, I have a lot of clients who own a home in the Los Angeles area. Well, if you own a home in the Los Angeles area and you've owned it since maybe the 1960s, you probably bought it around $30,000, but now it's worth $3 million. To sell it, you would have a huge capital gains tax hit. So one of the planning strategies would be to donate that home into this charitable type trust, sell that property within the charitable trust, no capital gain, and now you invest 100% of the sales proceeds for the remainder of the trust. Now again, you must leave at least 10% of the initial trust corpus in the trust at the end of the term in order for it to be legal and pass, all the scrutiny of the IRS, etc. Now, one of the problems with the charitable remainder trust, if you think about it, is that charitable corpus is ultimately going to end up going to the charity. It does not come back to the family. Yes, the family gets income off of it throughout the term, but they do not get the trust corpus returned to them like in the charitable lead trust they do. So how would you want to replace the wealth that you are now giving to charity for your family? Well, one of the ways is to take that income stream that you're getting every year off of the charitable remainder trust and invest in it into a life insurance type policy, which will of course have a death benefit. And then that death benefit just so happens to equal the amount or close thereto of what you've donated into the charitable remainder trust that ultimately is going to go to the charity. So what you've done by taking that income stream and investing in a life insurance policy, you're in a sense replacing the wealth. And so this is a typical planning tool. It's used quite a bit with our families that can get involved in these charitable remainder type trust. And the beauty of it is not only is charity, benefiting, but so's the family. The family gets the return of that donation through the life insurance policy. So a good summary of one of the things we've talked about today, and again, this is very basic. We can get very complicated with the charitable trust in terms of how they're used and how they're going to produce income, etc., how properties are going to ultimately end up going to charity and what have you. But what we've talked about today boils down to a very traditional approach. This is something that we all do, something you know about. It's a single contribution of money to charity in a particular year. Really go out and get that gift receipt for doing so, and you'll have that tax advantage for that particular year. Another way through estate planning to provide for charity is use it in your revocable living trust. I have a lot of clients that sometimes will ask me that what charities they want to can be donated to, and we'll go over that with you. But bottom line is that you're not gifting anything away during your lifetime. This is a testamentary gift upon death. So when you pass away, your revocable living trust will immediately send out to that charity of your choice, just like the money going out to your family members. And so they will get that charitable deduction at that point in time if it's necessary, but you're also making sure that the charity gets, the money that you want allocated to it. Now, if you want to be a little more complicated and have a little bit more control over the whole process, that's where the charitable trusts come into play. And as we discussed, we always have to set up the trust. We have to make sure the details are together the way you would like. We want to fund the trust exactly with the property that you do want to donate to the charity. Again, it could be real estate or other highly appreciating assets, including monies, of course. If you want to get nicely complicated, which I enjoy doing, it really boils down to setting up maybe a family limited partnership and or a limited liability company, and you're donating those interests to the charity that equal the asset in it and also equal, of course, value. Now, you'll notice that if we use the charitable lead trust, income goes to the trust, or I should say the charity, throughout the lifetime, and the corpus gets returned to the family. If you use the charitable remainder trust, the family ends up receiving the income through the term of the trust, but at the end of the term, the charity ends up with the corpus that is donated to the trust itself. If you want to replace that corpus, you have that income stream coming to the family, and you take it and invest part of it into a life insurance policy to replace the corpus that ultimately ends up going to charity. So with that, this is a brief introduction into charitable planning. We have gotten involved with charitable planning throughout our 30 years of being in existence. We also deal with donor-advised foundations. We can set up charitable corporations. So if you have any interest in donating to charity, please give us a call, and we'll go over not only how to do it, but all the options that you may have. And if you want, we can get as complicated as you like. So with that, Dale Bethel, Bethel Law Corporation, thank you for listening. And with that, we'll sign off.